Send it! What is going on, everybody? And welcome back. Dogecoin, Terra, Luna, CRONOS, Tectonic, and the rest of my beautiful people watching right now. Audio is good. Desktop audio is good. I already have queued up the Federal Reserve on YouTube, queued up good. And we're looking at Bitcoin right now in front of us. Very delicious, everybody. You are coming at the right time, at the right channel. There's a lot of different places to watch this, and I'm just super grateful and excited that you're choosing the Oscar Ramos channel to have some fun and enjoy, and to just, see what in the world is going to happen for the upcoming minutes and the upcoming hour. We're coming at you at, let's see what it is, 1:08 p.m. Central Time and 1:30 p.m. Central Time in the here in Texas. We're going to have the beginning where Papa Powell, Jerome Powell, is going to be talking about it. And then we're going to have, after that, he's going to be responding for like about 30 to 25 minutes. Reporters I remember it was September 21st when we were talking about it. He increased by 75 basis points. Now it's going to be happening again. And chances are that's going to happen. So there's a lot to say. We have couple of minutes before the FOMC, so get ready. Let's get pumping, let's get it started, because we know the next upcoming times that we have, brother and sisters, it's gonna be the moon. Whichever crypto you're rooting for, I just wanted you to do amazing. So you know what to do, everybody. If you like the content, go ahead and smash your like button. Please consider subscribing to the channel and turn on those notification bells. How's my beautiful people here watching? Mark, Prever, Robert, James, Drew, and more people here in the house. Welcome aboard, everybody. Welcome aboard. Oh, man, I'm excited. Finally, some more roar, some more sentiment and bullish momentum or bearish momentum, whatever momentum you have. We're going to be talking about it today. Let me show you this beauty. We have, of course, the markets right now, 1.1, and I have it ready. Hear this. I like this. Everybody there's now watching it, 2:30 p.m. Look at the tunes. Look at the Federal Reserve tunes, baby. I love this. So we'll be here. It's live now. So yeah, we'll be here. We're taking a look at this one, and FOMC meeting here on Twitter. Take a look at this. People are discussing Tuesday's Federal Open Committee. Talking and 75 basis points is expected. It's fair to say, everybody, it's fair to say that if we get anything well above that, the market is going to flip completely. And I think that's really what I'm looking for, right? Some more craziness expected, right? Howdy, what's going on, Crypto Cowboy? Happy to have you here in the house. So a couple of things that I just want to mention. This is just the beginning of many different events that we're going to be having. What else? Midterm elections right after this. So just for reference, you're looking at Bitcoin right now, which is the king of crypto. If the Democrats can hold the majority, probably we won't see that much volatility. But if Democrats come in that red wave that people are talking about in the mainstream media, pretty sure we're gonna see the markets react to that very massively. So I'm excited for whichever it does, but I know a lot of people are looking at that, and you have to be ready for the upcoming trends. Talked about earlier today about Dogecoin, and I'm very happy to see the community coming in and supporting. Dogecoin is one that, baby, look at that beauty, still doesn't want to give up, and it still is at 13 cents. Elon Musk sponsor. And Terra Luna Classic, everybody. Well, Terra Luna Classic a little bit down earlier in the week. Still is Wednesday, so right in the middle of the week. But we are seeing how it's approaching the 78 retracement, and it's kind of healthy, because if you wanted to be long in Terra Luna Classic, obviously the best way to start dollar cost averaging will be when it's extremely down. So whichever cryptocurrency you're looking for to get in today or tomorrow, or as we continue ending the year 2022, be wise, have money on the side, because you don't want to You don't want to kind of go through what I go through, my pains, which if I want to buy a crypto, usually I have to deposit money beforehand to buy it. But for some reason, that's kind of like the way I used to. And if I want to buy something, I have to deposit, transfer. Might take more than a couple of seconds, right? So you might want to have some money on the side on MetaMask, Ethereum, just sitting there. Once you find that good altcoin, you swap and you make a lot of money, you swap it back again to Ethereum, and then you cash out, or just having money relatively available. Got it? Should be pretty good for sure, guys. Tectonic prices and what parameter you uses? Well, TradingView and some DEX tools as well for cryptocurrencies that are not particularly on TradingView, everybody. When we talk about the FOMC meeting, raises the 75 basis interest rates, I like this one. This is not the first time I see this, but I think it's very important. 50 is not going to happen. It's not going to happen. So let's go ahead and start posting the questions that everybody kind of wants to know, right? Let me go ahead and do this beauty. I'm going to go to this and let you listen. Look at this OG music, right? FOMC rate hike today. We'll do with 50, then we do 75, then we do 100 basis points, yes sir, and then basis points. That will be good, and none. Send it. I'm excited. So we have about 15 minutes left. 15 minutes left for this to start. Welcome aboard. So gotta get my water. There you go. We're here. We're back. Which basis points are you guys thinking about? And the obvious one is gonna be 75 basis points, which immediately I see people voting on that one, so that's good. I'm showing you 1 hour on the Bitcoin, but realistically speaking, I love to see the 1 week because you need to see this, guys. Take a look at this beauty. We're right in I'm gonna hide the RSI. It's not that relevant here for me. Barely right now with the news, we are looking at a 2.5% increase, but that is what Bitcoin is at the moment. We definitely were able to reach $17,000 right here, then roughly 19, 18 here, and 18 here. So the good news for the market, especially for Bitcoin, welcome, it's that we're not really even close to the $17,000, and I don't think this news of 75 basis points are going to send us here. It's not going to send us here. Just take a look at September when we had the other basis points right here. It was this candlestick. We reached $18,000, right? $18,000 from roughly $19,000. So that was kind of like that week, and this was the other one of the 21. So worst case scenario, probably mid 19,000s, even high 18,000s, but it's not gonna go to 17,000 just today with the news of the FOMC meeting, because it's fair to say that the entire market is already pricing in the this news of 75 basis points. Got it? Just to give you that idea. And I'm going to add even more value to the conversation by adding the moving average. Everybody here knows that we are under, or if you didn't know, we're under the 200-day moving average, right? So if I do the 300 moving average and I put it on a color yellow so people see it, take a look where we are at. So the 300 moving average is by Benjamin Cohen, a YouTuber that I highly respect, right? Intraday cryptoverse. That is touching that is going to indicate that we are really in that winter where it's really, there's no sign for us to get up, but we haven't touched it yet. The 200 moving average is going to be somewhere up here, which we're in the middle. So it's the first time in many years that we are just going through and squeezing our sliding our way into this bear market. For all the events that are about to happen, I haven't seen how Bitcoin reacts to the midterms yet live, which I will. We're going to be live for that one too. And of course, the CPI data, which we've seen how it reacts to. That CPI data adds a little bit more flavor to the volatility. So today is that first day to start knowing that basis points are increasing and that the rates are increasing and things are becoming more expensive to borrow. Going back to 1 hour, and this is what we're seeing so far. I'm gonna hide the 300 moving average and enjoy this journey, everybody, because, well, right here, I'm really looking at Bitcoin right now just to see the volatility, how it's gonna all turn out to be crazy, right? Just to say, because I know for LUNC, it might also be a little bit more volatile today, which I'm gonna have it on the 1 hour. I think that's gonna be very nice to see the reactions of everything. Actually, I'm gonna go to the 15 minutes. 15 minutes is gonna give me a tick by tick breakdown of the market. For Dogecoin, I'm gonna also do 15 minutes. We are roughly 10 minutes away, and usually they take a while when 2:30 p.m. Eastern happens. So I'm looking at Dogecoin. I don't think Dogecoin is gonna retrace a lot. Even CRONOS is kind of having some nice, bull candlesticks here and there on the 4 hour too. So we'll go ahead and put the 15 minutes too on CRONOS and see how that looks when it's still close to that Fibonacci and resistance. Exciting, everybody. Welcome aboard. Don't forget to smash the like button, guys, and consider subscribing to the channel. Amazing stuff. We're good. We should go up and away. Not financial advice by any means. Do your research. Absolutely. What's up, James? Happy to have you in the house. Let's support our boy. Appreciate that, guys. Thank you very much. Waiting here. And for all my tectonic fam, still at €6.15. Clear crypto is going to 8 cents. Tectonic, we're looking solid, hovering that resistance, which is one of the golden resistances, right at €6.16. As you can tell, nowhere even close to the €6.19. But this guy, I'm already, priced in, and if it explodes, I'm gonna do very, very well, because that's what I want to be inside of the market. So far, 75 basis points is what all of us are saying. If for some reason we get 100 basis points increase, that will be so catastrophic to current volatility. We're gonna have amazing dumps, and if you have some money on the side, because I do, I'm gonna be buying left and right today. So in a way, I want 100 basis points, because what doesn't really matter if you are holding for long or if you know how to trade it well, you can come up on top, right? That is the idea. That is the idea, guys. Everybody, if you guys want to have a chance to earn up to $9,100, take a look at the link on the top of the chat. MEXC Global and I have partnered, and well, an opportunity. If you click on that link, you'll see a land page that's customized to me. Take a look at all the instructions. MEXC Global. Cheers. Drew, what's going on, buddy? Happy to have you. I'm just excited to have the people here and have my Rubik's Cube, because I'll be watching, listening to what your own Powell has to say, and thinking and kind of having a conversation about what he's saying. Last time he was like, we're just not going to slow down in enforcing and using all the tools at his disposal so the inflation comes down as soon as possible. Because these all conversations really go towards, can American families make sure they can survive and continue, living in an economy that works for them, and not just being hammered by increased pricing goods, food, gas, and energy. And it's important, right? It's not an easy task, in my opinion. It's not an easy task. Bradley, thank you, brother, for coming in and supporting. I appreciate that a lot. So I understand that. Obviously, it's important. So it's good to see some price appreciation here on Bitcoin and even on LUNC2. You're seeing the 15 minutes with me. We're almost there, everybody. What time is it? 8 more minutes to go. Love it. Appreciate that a lot, guys. They already announced the 75 basis points. Thank you. Thank you, thank you, thank you. Appreciate that a lot. So I'm going to go ahead and close this. When they do that, they do that a couple minutes before they do that, yes. So let's take a look at this because I already have it here. Should be on the latest. So people were looking 75, and that is exactly what we want. Everyone is kind of looking at this. So if it's 75, yes, Fed interest rates as expected. For the FOMC press release, correct. FOMC statement thread. The Federal Open Market Committee hiked the Federal Reserve rate by 75 basis points. It was the fourth consecutive meeting with such an extraordinary increase, with the Federal Reserve determined to bring down the pricing pressures in the U.S. economy. So 75 basis points as expected. So how are the markets reacting right now? Bitcoin just on the 1 hour chart, acting bullish. There it is. So for the last 15 minutes, probably wasn't added. Then final in this 15 minutes, it was added, and so far it was like the expected. Or you know, at 1 p.m. I believe at 1 p.m. probably, so 2 p.m. Eastern time that was set. That's really good. Dogecoin so far mimicking Bitcoin. Take a look at that. I'm looking at the 15 minutes of the 4 ones. That's what I'm seeing. How am I looking at S&P 500, SPX? Let me bring some equities here because equities are very important too, especially NASDAQ. SPX, take a look at the S&P 500 right now. So at 1 p.m., it reached and it went through 1.46%. So on the S&P 500, that is huge. That is for a 15 minutes. So yeah, that was when it was announced, the 75 basis points. Now, still waiting on this one, guys. About 5 minutes left for the Federal Reserve to speak on it. And I gotta tell you something, everybody. I love and I really am all in favor to learning and reading and understanding what this all means, because most of us 4 years ago, 3 years ago, 2 years ago couldn't care about this. And there's people right now who couldn't care about this, and 2 years from now will care as much as we care about this, because they will be in crypto because of the decisions we make today, right? Just remember that. Nobody told me about crypto 2 days ago. Nobody told me about 2 years, 4 years ago. And it's the reason why I like it, because it's something that we found and I'm like, no way. There's something else besides stocks and real estate. Yes, there is. How do you predict Ethereum to go before we dump? Everything looks good so far. Well, oh wow, Ethereum. Give me 1 second. 2.12% Ethereum, and let me see. Dogecoin, CRONOS. CRONOS also put in some work. Love it. That's a 15 minutes. Well, Ethereum, it did reach $800 when Bitcoin reached $17,000. Ethereum should be passing that $2,000 mark as soon as we get some good news. So that's why, if you don't have any Ethereum, mistake in my opinion. Ethereum is of course one that you shouldn't really pass on. Now with Ethereum 2.0 in the works, the merge already happened. Ethereum staking, there should be some good outlook and forecast for this blockchain. I don't like the fees, but it is one of the things that you have to go through, right, as an Ethereum holder, because man, the swap on MetaMask, I hate to pay $5, $6, even up to $10 on Ethereum, where you can do it on Binance Smart Chain, CRONOS, or other different blockchains, right? But it's in the works, and I'm sure that one day could get a little bit better. Time to short some equities. I know, right? That should be really, really fun. Shorting is the way to go. Welcome, welcome, welcome. Where are the Terra Luna Classic holders? Give us a like, everybody. Give a shout. Dogecoin holders, anyone here? What's going on, guys? Welcome, welcome. Hopefully you guys enjoyed the video alert today. Made it with a lot of love and appreciation to you. Ethereum and Bitcoin holders, well, you guys know me well. It is a passion. It is a passion. Team Tectonic, of course, Team Tectonic, and of course CRONOS too. Looking at this one live, and guys, take a look at the tunes. Our upcoming CPI data, November 10, has to be showcased. And we'll see if it actually works. Because already 75 basis points, it's on. So waiting on that one, my friends, we're ready for that. What do you think they're gonna say? That they're still super bullish on decreasing the the price pressure, as we saw here on Twitter. Because the pricing pressures in the United States economy, we got to bring it down, right? I mean, determining the pace of the future increase in the target range, the committee will take into account the cumulative tightening of the monetary policy, the lags with the monetary policy effects, economic activity and inflation, and economic and financial developments, the FOMC. Yeah, because it was already announced. Federal funds target rate now approaching the 4%. With this recent increase. So this takes the federal funds reserve from to 3.75, 4% high since 2007. Wow. God willing, I already got my house. It's locked much lower than that because, man, U.S. raised interest rate by 75 basis points. So it's already looked and said, done. Let's go ahead and tweet this one, everybody. If you guys follow me on Twitter, just a quick reminder right here so you know. And buy in the, let's see. Well, I'll just post it right here. That's data. There you go. Send it. There you go. We are ready to roll. Everybody, let's listen, let's enjoy. And on this one, I shut up, I mute my mic. Here we go, everybody, all yours.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food, and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common.
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostick's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make was covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on on that, what's the level we need to get to rates. And, I don't know what we'll do when we get there, by the way. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern.
Appreciate it, my man. Thank you, Johnny.
So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So
How big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
You know, it's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
All right. Everybody, I was about to look. Let's go. Tectonic, chilling. Very good. Everybody, There you go. Let's come back here and talk it out. 1 hour. 1 hour here. Very good. Fellas from everywhere, what is going on? And welcome back to the Oscar Ramos YouTube channel live. Happy to have you all back here. Thank you very much for joining me on that FOMC meeting, which we talked about it before, 75 basis points. He spoke about the entire thing, and nothing that he said was really breaking news. The only thing when he was asked, is inflation entrenched? Basically, is inflation already locked with us and we cannot get rid of it? And obviously he's like, well, that's why he's trying to do what he's trying to do. So we go back to the 2% goal from 8%. So obviously there's a bunch of things that has to happen, and in that journey we're gonna go through the CPI data report on November 10, and as we continue this year 2022. What I can tell you guys is everything when it comes to the price for Ethereum and for Bitcoin, I'm gonna go to the 1 day because this is gonna be super short-sighted and I need to come here. So this is on our way. Thank you very much, JB. Appreciate that a lot, my friend. Thank you, JB. You're the man. Thank you very much, brother. Let me show you because I need to bring this information to you. Hello, what's going on, buddy? Welcome aboard. The prices that we've been having ever since October, right? The end of the week of October and the end of the week and beginning of November, obviously was probably because everybody already was expecting the 75 basis points. And then we have the midterm elections, and then we have CPI data. Forecasting a possible bull trap where we could easily hit this low at 1,200 Ethereum and 18,000 Bitcoin once again. That means that for Dogecoin, what would that imply? Well, I have to go to the 4 hours here on Dogecoin and tell you, as I said earlier in the today with a video. I'm gonna bring it here. There you go. I gotta come back and start putting all this back together. There's a possibility where also Dogecoin retraces down to the 0.708 cents. Yes, there's a possibility because this occurred due to Elon's tweet, but that is a blue ocean unicorn type of crypto this time because obviously Elon Musk carries it on the top of his back, and that is really good. For the rest of us as normal cryptocurrencies with no richest man in the world influencer and advocate, obviously we see LUNC, for example, where the price was ballooning, but as of right now, the price is not going to be putting any other higher highs for the rest of 2022. That is my prediction and something that I've been saying for a long time. So it's heading to the 78% retracement. I'm going from crypto to crypto. You already know me. And for all my amazing, where are you guys? Tectonic CRONOS chain family. I already added my bags to Tectonic. And it seems that it was rejected at this level of resistance of 6016. Obviously, Tectonic did an amazing reach at 6019, almost 602. What does that mean? That if it wasn't for Elon Musk tweet about Dogecoin, probably Tectonic could have easily break onto those 602. But now, because we are going through this painful time in November, I have a possibility, guys, that we're not gonna see the price of Tectonic rise as of now because of the uncertainty and because of where the market stands. We need to carry all the midterms going, and we need to go through that and see how the markets will react, which possibly bearish. I mean, that's kind of what people are looking at, but positive and bullish because there's nobody's blinded to this, how the government and the United States in the mainstream media, because I watch all kinds of outlets and as someone who is in the news, I listen to what people are saying. And for the most part, people say, I don't think the country is going in the right direction. You can agree to disagree. That's totally fine. I welcome everybody here, but I'm not going to tell you a lie to please you. I'm gonna say it like it is always 100%. And as someone who has a brain to think, I can tell you that if the Republicans take over, there might be a relief in this country. There might be a relief in the economy. There might be a change in air, and people say, well, now as the Republicans take over the House, now it can be a much different direction for the country. That's yet to be seen. That's what I think. Let me know in the comments, what do you guys think? Because that's what I believe. And I'm not going to say something to please the public. I'm going to say what I believe 100%. So that's what I think, everybody. Obviously, the midterms are very important for this to move, right? Now, the last one is going to be CPI data, when it's going to come in a couple of days from now, about a week plus from now. And that could also bring the price of Bitcoin, the price of LUNC, the price of Dogecoin even much lower. But so far, I do believe that the price of Bitcoin as of right now is holding really well. There wasn't any major sell-off. What I was showing you during the live, what we were talking about during the live, for Ethereum, this is so funny. For Ethereum, I hope you guys like my smiley faces and sad faces, right? But it was just this candlestick. It was just this candlestick. This whole conversation was just one small, beautiful, fat, and delicious candlestick that barely people see right now. So we did not have a massive sell-off. We did not have a massive pump. What does that mean, everybody? It basically means the market already put it in their mind that, this was already anticipated. And this one had a result on today's episode. And this is going to probably happen for the rest of the week. The market already know. And if you guys were listening, because that's why, oh, actually, I'm super small. That's why I like to listen to the people in charge, because they're the ones who know what in the world is going on. They say, it seems that the market is already reacting to monetary policy right before we say something from the central bank, whereas before people will react after the news. So today's meeting, people would have started reacting, and probably the price of Bitcoin, Ethereum, Dogecoin, Tectonic, and many more would have already barely started to run today, right now. But it did right before, because that's how technology and that's how this whole thing works. Got it? I mean, that is that's kind of like, the big main things. Obviously, I ask you guys here, I'm going to go ahead and close the poll for all of us and see what in the world won. I ask you, which will create a bigger pump and dump? And with 352 votes, thank you guys. You guys said FOMC meeting, then none of them, then CPI report, and then midterm. So you guys are saying from the sample size that I have right here with me that midterms are not going to be much affecting the price. We'll see, because I already gave you an explanation how obviously a lot of people care where the country is heading. And I see you guys your response. Facts. Yes, I agree with you too. Look, we welcome everybody here in the chat, but you have a brain, you know that of course things are, for some reason, can be probably better and improve. And if the Republicans do take over the House, that could be, and also the Senate, because the Senate is also in play. But it seems that the Republicans have a higher chance of winning it. We'll see what happens, right? But I just wish, guys, understand that it is the very beginning for crypto. It is the very beginning for crypto, right? Oscar Ramos channel is going to be live, God willing, for many years to go. And crypto and YouTube and you guys, I'm going to take you with me. I'm going to take you with me, right? That's pretty much the idea. Because 290 plus people watching right now, it's just a tiny drop in the ocean compared to the amount of millions of people who are going to come from the knowledge that we received today, basically. So just know, right, that if it crashes right now to the prices that we were seeing back in, mid-October, just know that you have another chance, my friend. Do not miss it, because I did it. And I told you yesterday, I bought Clear Cryptos and I sold it at 10. Now look at this. I knew it, right? So with tectonic CRONOS chain, make some noise. There's a new roadmap update, by the way, which I'm super excited for it. Obviously, for Tectonic and VVS Finance, I already added, man. I already added. I'm not waiting any longer. These are cheap enough for me, but you have to understand which ones are not cheap enough, and the ones that are not cheap enough is going to be Bitcoin, Ethereum, and Dogecoin, and LUNC, in my opinion, is already at that cheap enough territory, in my opinion. Everybody, whoa! So what do you guys like? Go ahead and smash the like button, please, for me. Go ahead and subscribe to the channel. Thank you very much, guys, for all the donors that are coming in. And if you want to deposit and trade to get a chance to win $9,100, well, you might want to go ahead and click on the top of the chat, because partner with MEXC Global. What a nice company, guys. And there's this deposit and trade. Check it out. If you already have it, look at it. But if you don't, you might want to think about this one. FY, everybody, think about it. It's in the description link down below too. Cheers! My fellas. So really, I think the FOMC meeting went well, and it is what we were all expecting. And wow, honestly, this is really what we wanted, to finally get this over. And look at this dump. It's not coming a little bit lower. Let's go ahead and get closer. Look at this. 20,161. So right after the meeting starts going down. Look at look at S&P 500, baby. Look at this. Okay, let's go ahead and get closer, everybody. Don't go anywhere, guys. Look at this. So Dogecoin, how about Doge? Doge actually is reacting pretty positively, but look at Bitcoin in the 1 hour. So it already reached this, I will say, consolidating pace that I've added. We were passing this one. I'm gonna go ahead and add the 1 week, because I want to show you how close we are to the 300 moving average. Even with this nice retracement that we're experiencing, nowhere even close. We need to go down and lower about 10% to really be in unshattered territory. 10% drop in Dogecoin. We are in the winter for 2023 too, basically. So be ready. What's going on, guys? Welcome aboard. If you have a question, post it in the chat right now. Send it, guys. The FOMC meeting has ended. Questions, AMA section. Let's go, guys. Welcome aboard. For all my fellows and sisters, brothers and sisters who speak Spanish, I'm starting to speak on my Spanish Espanol channel. Link in at the bottom of this of the description in this video, guys. Check it out. Subscribe, because there's more content in Spanish that I'm gonna be making for ya. Let's go to the 1 hour. Pretty exciting, to be honest with you. That is gonna be this one, an S&P 500, man. Let me go ahead and take a look at the crypto bubbles just right now a little bit. Crypto bubbles for the 1 hour. Ooh, oh, just chills. It's up. Everything pretty much is red in the 1 hour. What about the day? Let me go ahead and get you guys looking at this. This is the 1 day for us, and this is the 1 hour. This is the reaction that is happening right now after the meeting. Right after the meeting. For this bull run, I think the token of crypto company that have ATM card will win more. Robert, thoughts on the TERRA? I did a little bit of a look at on that one, and I think it's a great blockchain, brother. I don't have any, but it really amazes me, the technology. Yeah, Johnny, I'll make that one for sure. It's on my list. Thoughts on Tonic? It's almost the anniversary. It's true, right? Well, I have it right here with VVS Finance, and when it comes to Tonic, everybody, and when it comes to all of these cryptocurrencies, we already know the good and bad when it comes to should I buy it or not, because they come up, they drop. I already decided to get on board, added about 3 billion plus to my position on tectonic. I believe that I need to wait a while so the roadmap actually becomes true, knowing that 500 trillion in supply, obviously less because a lot of it is staked and put aside, but you don't have to, crush your head too far to know that if burns are not implemented with obviously the developers and on Discord, they say a lot that they don't want to do it, which is I mean it's totally fine. Don't have any problem. They don't want to add listings too. That's their position. Totally well with that. So it's a project that it might take by the end of the year, next mid-year, by the end of 2023, mid 2024. I won't be able to tell you when exactly it's gonna really balloon to the moon so everybody starts talking about it, but I know one thing, and it's from the CRONOS chain, and in my opinion, I think if I lose all my money, listen to me closely, if I lose all my money on tectonic, if I'm wrong, if I'm not looking at something that I should be looking at with tectonic and it goes sideways, I am at least happy that I gave it a try. I'm at least happy because obviously everything in crypto involves a risk, but I wasn't a whining person, fearful, like, no, I don't want to get into this one. One of my first DeFi opportunities in 2022, and I tried it. And if I'm wrong, if I lose my money, fine. I don't care. It's okay. I have money I'm able to lose. But if I'm right with everything I have learned about the CRONOS chain, crypto.com, CRONOS, tectonic, VVS, finance, NFT, metaverse, borrowing, lending, I'm gonna make it, my friends. I'm gonna make it, family. It's not even on any other listings. They say they can be added. They say it cannot be added. Sure, time will tell, but that's the way I see it. Am I the only one? Right? That's the way I see it, guys, right? So I come to you and I tell it to you like it is in a way. Obviously, now everything's right. Now pretty much everything's right. So this is just the 1 hour and I see the Bitcoin and it's, moving ahead. Where's CRONOS? Since Dogecoin is not moving that much. Look at CRONOS. Look at CRONOS, baby. Oh, man. That's my dear CRONOS. So, let me see the comments. We're going to make it. I'm with you. Hope you do, Oscar. We want our control. Theme tectonic. Crow retirement plan. Oh, yeah. You got it, baby. You got it. You got it. We like your take on quant. Many people love the tokenomics. Haven't done my take on quant yet, brother, but it's another one that I'm happy that it's playing and it's making a lot of people money for sure. CRONOS Army, let's go. So, family, friends, we might see some couple more volatility now as the next event is gonna be the midterm elections. Whether you are rooting for right or left, blue or red, whoever you're rooting for, wish you the best. And remember, we're all in the same team in crypto. In crypto, it's not like politics. In crypto, everybody's on the same team. We're all gonna make it. Walk me. We're all gonna make it. All right? Family and friends, before you leave, don't forget to smash that beautiful like button for me. Please subscribe to the channel. Turn on those notification bells. You want to get some money, take a look at the link at the top of the chat. Made it for you. Gave it a partnership with MEXC Global. Have to do anything but just give it a try and see if you make money. What a great deal, right? I want to say thank you to all my beautiful moderators, members, JB, Mommy of the Aka, Prever, you coming here. The new subscribers, my name is Oscar Ramos. Happy to have you here in the house. Hope you liked the FOMC meeting. It was pretty cool. Expect it. It's going to be fine, guys. More videos coming up and more relaxation sensation. Muchas gracias, chicos. Los quiero bastante. Tengo hambre. Voy a comer. You guys take care. Thank you very much. Thank you for all the donations, guys. I'm super flattered. And let's just go ahead and enjoy, right? Hope the live was good. I always try to keep it short, relevant, and important to all you guys as well. There you go, guys. God bless you all. Please be safe. Have an amazing time. Today is Wednesday, so let's enjoy Wednesday. I'll see you next time, everybody. Peace. Catch you in the next one. Thank you, guys. You're awesome. Bye.